Fed Reserve Chairman Jerome Powell has dealt a blow to the world's main currency with his dovish comments. At the same time, the Bank of Japan's governor, on the contrary, completely refused to comment on the recent actions of the regulator. Tokyo is sticking to its guns and continues to keep markets in the dark about its currency interventions. Given the sharp strengthening of the Japanese yen, it can be assumed that the Japanese authorities have intervened in the currency market for the second time this week. The 160 yen per dollar acts as a kind of a barrier that the currency pair should not go beyond. The dollar-yen pair plunged so quickly that it even touched 153. Today, the yen tried to trade lower in the intraday corridor between 154.10 and 156.20. However, the Japanese yen has been trapped under strong greenback pressure. Moreover, the large difference in interest rates between Japan and the United States is sure to persist for some time. The yen has already weakened more than 10% against the US dollar since the start of the year, as the Bank of Japan encouraged carry traders to take action. While the yen remains the weakest currency in the US dollar basket, it's most bought to invest in high-yielding peers. The Deputy Minister of Finance promised on behalf of Japan's government that reports on forex transactions would be disclosed at the end of next month. At the same time, Satikanda repeated that the authorities would take appropriate actions in the currency market when necessary. Therefore, the US dollar remained extremely volatile against the yen today. Although in pairs with the most major currencies, the greenback incurred losses. After yesterday's blow caused by the speech of the Fed chairman, the US dollar not only broke through the support level of 106 points, but also immediately fell below 105.50. Today, its index consolidated in a narrow range of 105.60 to 105.80, but the indicator is still blinking green on its trading chart. The policy decision unveiled by the rate-setting committee yesterday still contained hawkish notes. Yes, Fed Reserve policymakers kept interest rates steady between 5.25 and 5.5%. Moreover, the Fed chairman ruled out the possibility of a new rate hike, but at the same time, inflation in the US remains sticky. In recent months, there has been no significant progress in taming inflation at all. Thus, the regulator will need more time to see a sustainable decline of consumer prices towards the target of 2%. Market participants have drawn the conclusion that interest rates in the United States will be kept at the current high levels. As for the peak values, Jerome Powell made the comment remarks that much will depend on incoming data. In recent weeks, economic data have been adding more questions than they provide answers. For example, yesterday's reports on employment in a private business turned out to be unexpectedly stronger than forecasts. Besides, the manufacturing PMI also suddenly found itself again in the technical bearish zone, below the threshold level of 50 points. At the same time, price pressure in the manufacturing sector has increased sharply. Now, the market attention is focused on the key monthly US employment report, which is released on Friday. It will shed light on the strength of the US labor market and determine the future prospects for the US interest rates. The diversity of opinions and forecasts was reflected in a sentiment on Wall Street. After all, since a rate hike in the United States is out of the question, this should be a positive factor for stocks. However, by the end of the New York session on a Wednesday, the S&P 500 index lost its earlier gains. The index opened the American recession indicator between 5,300 and 5,096. Curiously, even with such a dovish scenario, the Fed Reserve still remains the most hawkish regulator on a macroeconomic scale compared to other central banks of the G10 countries, especially in the Eurozone. Recent statements by ECB policymakers have often highlighted June as the deadline for the first rate cut. That's Europe. As follows from the comments of financial policymakers may begin lowering rates much earlier than the United States. In addition, the relatively weak economic performance of the Eurozone, in contrast with the strength of the US economy, will reinforce the dollar's growth in the future. In the meantime, the euro-dollar pair is likely to experience a significant decline. Following the decision of the US Central Bank, the single currency fell below 1.07 against the greenback. Although Jerome Powell somewhat calmed the markets, assuring that the likelihood of a rise in interest rates was extremely low, the euro did not rally. After all, the situation has not fundamentally changed. In any case, the Eurozone will not only be the first to start rate cuts, but it will also do it clearly faster. Consequently, the current discrepancy in the monetary settings will only increase. Now the movement of the euro-dollar pair in the range of 1.0691 to 1.0731 fits into the overall picture of a recent stagnation. To get out of the flat market, the bulls need to push the price above the level of 1.0750 and try to consolidate the high required. Otherwise, the euro will continue to fluctuate along the same 1.07 level as has happened over the past few sessions. In this case, the euro risks falling under selling pressure and will be an easy target for buyers. Oil sellers have also become more active lately. Futures for the benchmark Brent grade have already lost more than 3%. Its price sank below $84 a barrel. Although crude oil is trying to show modest growth today, it looks more like an attempt to slow down its rapid decline. Oil has been losing ground for a whole week, largely due to the two factors: production volumes and the geopolitical fears. Oil output rates are gradually growing, while the geopolitical jitters have calmed down. So, oil currently has no ground drivers. Rumors about a possible reduction in production volumes by the OPEC and its allies still remain just assumptions. There are no official statements on this matter. You have watched the market review by InstaForex analyst for Thursday, May 2. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments. I'll see you online tomorrow.